Hello everyone, today on the final bar, another distribution day as semiconductors lead the way lower. Breadth conditions are weakening. The McClellan oscillator confirms the pullback phase. Willie Delwiche of Highmount Research will be joining us live from Milwaukee, Wisconsin. Are we seeing more fear or strength in this market? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets every day using the Technical Analysis Toolkit. I would hesitate to tell you that technical analysis is best used in a vacuum. I would actually say that is a very bad way or inappropriate way to use technical analysis. I think of technical analysis as part of the picture. A holistic investor takes good technical discipline, looking at the price action of stocks and commodities and indexes, compares that to the fundamental stories. What are these companies doing? What are their prospects for growth? The macroeconomic situation, right? What's the big picture? Interest rates, the Fed, geopolitical activity, all of that. And then that fourth important pillar, behavioral, in my opinion. What happens between your ears, all those biases that you bring with you when you make investment decisions. We focus a lot on the charts here. We focus on the technical pillar, the technical leg of the stool, but don't forget those others. And I think it will serve you best to reflect on how that technical discipline that we talk about every day on the final bar can be best used in concert, right, in connection with those other very important disciplines. We have a great guest today, Willie Delwiche. Really comes from sort of a blend of a couple of those different pillars, but I think of Willie as a really effective macro strategist who understands the charts, and I think someone like Willie has a really good ability to shed light on what we're seeing in uncertain times. A lot of debate about strength versus weakness, fear versus greed, short-term deterioration or short-term dislocation versus the long-term trends. Let's take a look at the markets today, see what happened and how this helps us paint this continued picture as we go to our market recap. Before we look at the charts, by the way, we're going to get to a poll question. We asked you recently, where will Tesla be 1 month from today? As a reminder, best way to get our polls, subscribe to our YouTube channel. Go ahead and do it right now and give the video a like while you're doing so. We asked you, where will Tesla be 1 month from today? 10% higher, up to 10% higher, up to 10% lower, or at least 10% lower. I'm very interested to see the spread here, right? The dispersion of answers from at least 10% higher to 10% lower. And if you wonder why a market is choppy, if you wonder why things don't feel particularly straightforward, where it feels like the next steps are a little muddier than normal, this sort of poll question shows you how that's the case, right? Within this group of viewers that we surveyed, about an equal amount saying we're going to go at least 10% up, another equal amount saying at least 10% lower. And that is about how this market feels right now. Let's look at a chart of Tesla, see if we can get to any sort of sense of things right now. Now, the reason why I think it's tough to make this call right about now, which is why we asked about this particular stock at this particular time, because it's kind of in the middle of the range, right? If you think about 300, not too far above current levels, maybe 50 points higher. Think about we'll call it 210 or so, 215. That's the low from August. We're kind of right in the middle of this, range. 10% higher only gets us to around 275. 10% lower kind of gets us down to a retest of the August lows. So the question is, do we remain within this range or do we break out? I'd probably answer we kind of remain range bound only because 1 month from today, we could actually deteriorate quite a bit and then have another V-shaped bounce like we did in August. Get right back above 220, 225 and have a lot of movement between here and then, but in the end, not really go that far. What's interesting about a chart like Tesla, I think, is you have to take a step back and just think about all the evidence, right? And I think of technical analysis as a checklist. And when I'm teaching, new analysts, or when I'm teaching my premium members at Market Misbehavior how to use the technical toolkit, I encourage them to literally do a checklist style, start at the top with Dow theory, what is the trend, and then go from there. And what concerns me about a chart like Tesla is it's below the 50-day moving average. Now, that on its own is not the end of the world, but I feel much better about a chart like this if it's able to get above the 50-day. Or think of a chart like an Amazon or something finding support at a 50-day moving average and not breaking down. That's why charts like Amazon and Alphabet and others have looked so strong. And charts like Tesla look a lot less. They're in a different bucket because they're not holding the 50-day moving average. Most stocks in the S&P are also not holding their 50-day moving average. I think the RSI might be one of the more important things to watch here if you're more of a chart aficionado, because we're sort of right at the point where a bounce would most likely stall out. So I think that would be a bit of a concern. I'd probably say between 0 and 10% lower. I'd probably say in this range. Thanks for making me think, though, and I appreciate you guys answering the poll questions. We always have one going on our social media accounts, so make sure you follow us anywhere you see Stock Charts and Stock Charts TV. Let's continue on with our market recap and look at what happened with the charts today. The S&P 500 down about 1/3%. The Dow actually finished narrowly in the positive, up about 0.2%. The NASDAQ down, NASDAQ composite that is, down 0.9%. So this has been a familiar pattern of the sort of more value-oriented components of the S&P 500 doing okay, right? The Dow sort of leaning more toward those, sort of non-growthy sectors, as much as the NASDAQ composite is very growth-oriented. So we're continuing to see growth kind of lead the way lower in this corrective phase, this pullback phase that we've been talking about. Mid caps and small caps down as well, and I'm not forgetting my conversation yesterday with Ari Walden. If you missed that one, a really, really good discussion about the technical configurations, short-term versus long-term. And one of his comments was thinking about the strength and really the lack of follow-through in small caps, right? This consolidation phase with the IWM, the Russell 2000, with the S&P 600. And looking for some sort of breakout. I think a valid point is, small caps finally break out of that range. That would probably be as good a signal as any to recognize an all clear, right? Telling you that the breadth conditions are improving and that things are kind of back to a sort of slow and steady bullish phase. What happens if small caps break down, though? That's the bear case. And another reason to watch that chart of the IWM or the S&P 600. For now, leading the way a little bit lower and underperforming the S&P. The VIX essentially flat from yesterday. We talked about volatility and how rising volatility, I think, in this kind of environment, not an ideal sign. It's still relatively low, right? The VIX down in the 14 range is pretty low relative to where we've been the last year or two. But seeing an increase in the VIX, we had a spike a bit on the first leg down in July into August. So increase in volatility here. That's why it's important to watch a chart of the VIX. Volatility doesn't spike when people are getting more confident that things are getting better. It spikes when people are getting nervous. And so that would be a sign of warning that I would be looking for. Looking at interest rates, we're going to talk with today's guest, Willie Delwiche, about 10-year yields and other interest rate related questions, I hope. But if you look at the 10-year yield today, coming off just a bit, not too bad, around 4.26 for the 10-year. 30-year yield around 4.35, similar to the 5-year yield, just below 4.4%. Bond prices popping a little bit higher. I was doing a monthly chart review earlier today and noted how the if you take a step back from the chart of the AG, which is the bond aggregate ETF, in a clear downtrend, right? We could debate the short-term movements, but overall the trend has been down for the last 6 months, clearly so. And the trend in yields has certainly seemed to be higher. And I'm inclined to assume that those sorts of trends will persist until the chart tells me otherwise. And I'm not getting that sort of signal today. The dollar ETF, the UUP, was up about 1/4%. Looking at commodities here, sort of flat for some of the major commodity ETFs that we track. The DBC just down slightly, about 0.2%. Gold just above yesterday's close. Silver down just under 1% to the downside. Natural gas, the biggest gainer of this group, with the UNG up 2.6%. And oil prices came off a bit today as well. Finally, cryptocurrencies popping a little bit here in the last 6 hours or so. Bitcoin around 25,880 and Ether just below 1640. And again, Bitcoin testing a really key support level, kind of in that 500 sort of range. While the long-term thesis for Bitcoin could be positive, in the short term, we're kind of testing support. And the question for me is less, what's the incredible upside in Bitcoin, and more, is it going to hold the support level? For now, it appears to be holding. I think Bitcoin below 25,000 all of a sudden has a very different look to that chart for sure. Finally, looking at sectors, we're seeing another day here with some pretty defensive stuff at the top of the list. Now, I'll show you the chart of the XLU in a minute, and you'll see why I am not declaring a massive rotation to defensive sectors. This is a one-day thing. We've had a couple days this week where utilities have been at the top of the list, up 1.3%. Real estate's up 0.8%. But let's keep in mind, utilities are it's a pretty rough chart, right? I mean, it is not a strong chart over time. So we're bouncing off of some pretty low levels. I think a broader rotation to utilities or real estate or consumer staples over time could really indicate a rotation to more defensive positioning. We're maybe seeing beginnings of that, but it's nowhere near where you'd have to think, okay, this is a broad rotation to more defensive sectors. Technology, the XLK at the bottom, down 1.5%. I'll show you some of the charts of semiconductors, and you'll see why the XLK ended up at the bottom of the list today. Let's take a look at the daily chart of the S&P 500. Take a look at where we're at. You know, I've now just sort of permanently affixed these arrows onto my chart. So now I guess there should be no question as to where I'm sort of the general read that I have on the markets here. And I'm adding some extra bars on the end. By the way, if you're a stock charts person and you use our platform, which you obviously all should, a little trick is if you put extra bars down here, it just gives you some room. The stock charts platform was designed to show prices right up to the edge. I've used other platforms where you have a little more extra space on the right. So that's all you need to do is just set it up so your default charts add some extra bars. It's the easy way to just give yourself some room to sketch out some potential future paths. And I would say, you know, based on the trends, based on the price action of the S&P and, you know, also some key individual stocks, and in no small part on measures of breadth that have been deteriorating, I'm sort of seeing this as a pullback phase in a couple different steps. You call this an ABC correction. You can call this a, you know, drop, I forget what some people call it, you know, skip drop or something like that. You know, any sort of, three-wave pattern to the downside. That's sort of what this is starting to look more and more like. Now, I'm drawing kind of the idealized version based on wave A, or that initial wave down off of the high in July to the low in mid-August. Took about, 3 weeks or so to get to that point. We then had a couple weeks going back up at the end of August. And now coming out of the Labor Day weekend, we've obviously been rotating lower. The base case that makes sense to me based on the price action to date is that we continue this pattern and you have an equal wave, which would get us down to around 42, 42.50, depending on, you know, again, how much time and what sort of trajectory we have. But it's sort of right in this confluence of support levels. You know, with a number of my guests, we've talked about what sort of things to look for. The 200-day moving average currently around 41.70. And I think as long as we hold that, how bad are things getting? Not that bad. Charts like this break the 200-day moving average. While it doesn't necessarily mean the end of the world, it certainly tells me to really engage some thinking about further downside objectives. Think about downside protection, right? Think about how you navigate, how you manage a portfolio through more of a protracted decline. For now, this sort of is lining up to similar pullbacks within bullish phases that resolve higher over time. But these corrective phases can take weeks, if not months, right? I mean, there's been plenty of times where pullbacks can actually take quite a bit of time. In the end, they resolve higher, but it can be painful in the short term. So some key levels, I think, to watch, and this trend line from the major lows over the last 8 or 9 months seems to line up pretty well with that basic measurement, looking at the price action coming down on the S&P 500. Now, I mentioned the McClellan oscillator on yesterday's show. I just want to reiterate, what we talked about was most likely the McClellan oscillator was going to get below zero. It certainly did that. It's now confirmed that move below zero. So I didn't actually change the color coding, but I would color code you know, today and yesterday now as bearish red. And what that means is basically, you know, the trend, the McClellan oscillator is based on changes in the advanced decline data. Advanced decliners every day, how many stocks close up, how many stocks close down, and by looking at that net change every day, you can come up with a data series of advancers versus decliners, what you call a cumulative advanced decline line. The McClellan oscillator takes moving averages of that advanced decline data for the New York Stock Exchange and turns it into this McClellan oscillator. Very simply, it's kind of like looking at an RSI for the markets as a whole based on breadth. And the analysis is if it's above zero, it's bullish. If it's below zero, it's bearish. This is not a long-term signal. This is not telling you that it's a new bull market phase or new bear market phase. It's more tactical shifts and looking at how the picture is changing, you know, day to day, week to week. So you can see in the red shaded areas what has happened to the price action. I did that just to show when the oscillator is below zero, what tends to happen to price. And you can see in the green shaded areas what's tended to happen when it's above zero. So the fact that the McClellan oscillator goes back below zero, again, doesn't necessarily mean we're going to go, you know, the S&P is going to go down another 500 points, but it tells me that until I get some sort of contrary signal that the trend is lower, and I want to be assuming that that is the next step until the chart would reverse. So McClellan oscillator now back to a bearish configuration. And again, looking at the last couple years, it's been remarkably good at recognizing early on in corrective phases when we're going to have a pullback. Sometimes it's been a couple weeks. Sometimes it's been more of a time correction like we saw in April and May. But in all cases, it's been usually a good time to be a little more cautious, a little more defensive in your approach. Now, I mentioned utilities, just looking at the chart of the XLU. I think it's one of the great benefits of charting. If you're just looking at the action today, and you see that utilities are at the top of the list, you see that they're up 1.3%, your thought is, oh my gosh, defensive stocks are working. It's time to start thinking defensively. You know, not necessarily, right? The chart of the XLU shows you that this has essentially been a sideways chart for years, and we're bouncing off of a fairly low level. Now, does this mean we might have a couple weeks, a couple months of higher movement in the XLU? It certainly could be that. Do I think we'll have a lot more warning before it actually gets to that point? Probably, and that's why I would say just, I think it's best to be patient in this kind of environment. See if this is beginning of something further. And I think the opposite can be said for some of the leading charts that have done so well, right? Charts like Amazon and Alphabet will tell you when the uptrend is no longer in place because they'll stop going up and they'll start breaking down. One day does not make a change in trend, but over time, starting to really put in higher lows, starting to break above moving averages, that's what tells you that the conditions are really starting to change. I think too early to really make that sort of declaration on utilities or real estate. To the contrary, where you're seeing assets rotate are things like energy, where the chart is actually up in an uptrend for multiple months, right? We're seeing how investors are accumulating energy and how the price is going higher, particularly as we make higher lows and higher highs on the way up. Just to finish off here on some individual stocks, charts like Amazon, Alphabet, and others, they're just not bad, right? They're not broken. And that's why when we talk about what an ABC correction might look like, when we talk about downside objectives on the S&P, the reality is some charts still look quite good. Amazon is actually finding support at its 50-day moving average again this week. And that's happened a number of times just in the last month. We've seen Amazon pull back to an ascending 50-day moving average. We keep finding support there. When that stops happening, when we try to find support and it doesn't work, that's the signal that Amazon is no longer a strong chart to the upside. But I would say for now, Amazon still in a position of strength. Alphabet still in a position of strength. We did a YouTube video on Alphabet end of last week talking about the momentum characteristics and how it's just pretty consistently strong. Speaking of charts not consistently strong, I have to finish off looking at some technology names. Seagate Technology, one of the biggest drops in the S&P 500, actually might have been the top loser in the S&P today, down about 11% today, gapping lower. And gaps are interesting, not just because they happen, but it's always interesting to see what happens after that initial sell-off. So Seagate gapped down at the open from around 71 and change to 67 and change. And then that was just the beginning. Spent the rest of the day retracing to the downside. What concerns me here is it's not just that. It's semiconductors like Skyworks, SWKS, down over 7%. What else was on there? Was it Intel, I want to say? It was not Intel. Intel's actually up 3%. A number of semiconductors besides Intel actually rotating to the downside and pulling back. What's great about a chart like Intel is it shows you when stocks are diverging from their group. And Intel's a bit of an outlier in the semiconductor space. It's not unusual to see sort of the general semiconductors dropping down and Intel actually trading higher. Look at this breakout above resistance here, getting above 37 or so. Tested that in June, again in July, actually making a new swing high. I would argue always a good time to own good charts. We're going to take a moment here and with a couple announcements, then we'll bring on today's guest, Willie Delwiche. And the announcements are as such. We would love to hear from you, particularly questions. Our mailbag segment that we do on Friday, we'll do one on tomorrow's show, is all fueled by people like you sending in questions. What are you running into as you are trying to use charts to analyze the markets, as you're trying to trade and change positions based on the best practices of technical analysis? Let us help you point you in the right direction. Our email is thefinalbar@stockcharts.com. On the X, we're at FinalBarSCTV, so just tag us in a comment there. Also on our YouTube channel, of course, just drop a comment below the video that you're watching. While you're there watching this video, make sure you like the video, subscribe to our channel if you would. That would be fabulous. Also, as a reminder, every Wednesday, 1 p.m. Eastern, 10 a.m. Pacific, we do a live Q&A. We had a lot of fun this last week. Some of the mailbag questions you may hear tomorrow came from that live Q&A. We had a lot of great questions that came up. That's every Wednesday, 1 p.m. Eastern and 10 a.m. Pacific. So make sure you go to our YouTube channel next Wednesday at 1 p.m. Don't miss our next live Q&A. I want to welcome on today's guest, Willie Delwiche. Willie's the investment strategist and founder at High Mountain Research, coming to us live from Milwaukee, Wisconsin. Willie, good to see you again. How are you?
Thanks, Dave. I'm really, really good. How are you?
I'm well. I'm well. It's a lot happening, of course, and I'm really excited to bring you on the show today. You always do such a great job of taking a lot of noise and boiling it down to things that really help put things into proper context. Let's talk about rates. Let's start there because obviously rising rates have been a key story for the markets. It's put pressure in a lot of ways on growth stocks. What do you see about the interest rate environment going, up until now and going forward?
Yeah, so I really think that investors, if they pay attention to anything I say today, need to pay attention to this. The long-term trend in rates and yields has shifted, and it's moving higher from a longer-term perspective. We're looking at a chart here of the 10-year T-note yield and this trend indicator that I've got. Just on a weekly basis, this trend indicator has been rising for 140 weeks in a row. The last time we had that was back in the 60s that we had something longer. The bottom panel, though, I think represents this generational shift that we're rising over the past 5 years, more over the past 5 years than we have at any point going back to the mid 80s. So this higher highs in yields, this shift in trend is something that investors really need to be positioned for. And I don't think they are. I think it's still this assumption that we're in that environment that we had for the past four decades, which was lower highs and lower lows in terms of bond yields. That I think the chart is showing has definitively shifted, and now we need to accept that new reality.
It's a great chart, and I mean, just to be clear, this is a long-term chart going back to 1970 here. So it's a great amount of data just showing this, incredible long-term downtrend in rates that seemed to have reversed. So, Will, you mentioned that you feel people are not necessarily positioned for this reality of rising rates. I would tend to agree. When you say people aren't positioned well, what does that mean to you, or what do you think people are exposed to that they should be at this point?
Well, I think it's more what they're overexposed to the areas that have benefited from this long-term downtrend in yields. I think, you were talking about semiconductors earlier. Technology generally, that is a sector that has benefited from, basically zero or falling discount rates for a generation. I think we need to start to acknowledge that reality has shifted, and just position for it.
This is a tough chart, Willie, because I feel like a whole generation of investors are not prepared for a rising rate environment, myself included. I would say we just haven't experienced it in so long, right? Chart number 2. Let's talk about non-U.S. stocks. I mean, U.S. stocks have been sort of the story. Talk to us about All Country World Index, ACWI, and what the trends in the global markets tells you about the conditions here.
Yeah. So for a while, we've been talking about global strength. We've been trying to take advantage of that. Kind of another one of these trends that investors aren't prepared for is a shift from U.S. leadership to global leadership. I think that probably plays into the yield trend shift as well. But what we're looking at specifically here is a little bit more short term. We're looking at the percentage of ACWI markets that are above their 50-day average, the percentage are above their 200-day average. That's what we got at the bottom. And just comparing that to the ACWI overall. And just as a quick rule of thumb, if you get 70% or more of ACWI markets above their 50-day average, the market tends to go up, both the ACWI and the S&P 500. When it's 40% or below, the market tends to struggle. That's where we are right now, with 19% as of 2 days ago. Yesterday, I think we dropped down to 14% of ACWI markets above their 50-day average. But here I want to step back and talk more about the percentage above their 200-day average, because that reflects a shift in the longer-term trend. It's at 47% as of a couple of days ago, dropped down to 40% yesterday. And as we were talking beforehand, this isn't just a US dollar story. This is US dollar represented right here, but in local currencies, still only about half of ACWI markets are above their 200-day averages. So we're really seeing this global deterioration right now. Yes, the dollar is exacerbating it, but it's not just about dollar strength that's putting downward pressure on global stocks.
It's interesting when you look at a lot of those individual country indexes or ETFs, you're seeing it's not just a U.S. decline, right? I mean, this is sort of a global equity decline. I 100% agree with you. I want to get to your third chart here because this is really interesting. We mentioned in the introduction, are we seeing more fear or strength? Talk to us about this fear or strength model, what it's telling you about the sentiment here.
Yeah, so we want to be bullish from a tactical perspective if we see either fear or strength. If we see the VIX above 28.5, and you talked about how the VIX is low right now, we don't like it rising, but we like to see it high. That's a sign of fear and capitulation. Or we want to see strength in the market. We want to see more stocks making new highs versus new lows. This, in my calculations, it's similar to that McClellan oscillator you were talking about,
Sure.
except rather than advanced decline, it's highs versus lows. And so the chart here is showing what happens if we have either fear or strength. That's the green line at the top. Over the past 2 years, the market's up 20%. If we have neither, like we have right now, we have neither fear nor strength, the market's down at about 16% over the past 2 years. This isn't a short-term phenomenon. You go back to 1990, all of the net gains in the S&P 500 have come in the presence of either fear or strength. And from a tactical perspective, we have neither right now. And so, as strategists and as investors, we always like to finish up with, well, what do I do? So what do I do right now is stay cautious. Don't be afraid to be tactically on the sidelines because the conditions aren't there that says we're at a fat pitch opportunity.
No, this is super helpful. I really appreciate you talking through that, Willie. When we're talking about the S&P 500, I mentioned in the market recap sort of this overall configuration that we've seen, this potential drawdown, or the drawdown we've seen so far in August, and the potential to go further. When you look at the market in this sort of environment, I feel like there's this a FOMO on both sides, right? There's the fear of missing out on the next move higher. There's this fear of losing everything. In this sort of choppy environment, what sort of things are you looking at to, I guess, remain patient? What sort of signals would compel you to take action, here in the coming weeks as we lead up to the September Fed meeting?
Sure. So two things. One, go back to that fear of strength model. If we see more stocks making new highs and new lows, then any sort of consolidation we had in August has probably run its course. Right now, we're not seeing that. The other thing I would look at from a sentiment perspective, had lots of excessive optimism coming into August. A lot of that looks like that has been unwound. And if that's a healthy reset, we should in the coming weeks start to see optimism creep a little bit higher. From my perspective, that would be a sign of strength. That would say investors aren't bailing on stocks, and so then we can lean back into stocks. What really becomes a problem for investors is if you have weakness compounded by everyone turning bearish all at the same time. Excessive pessimism is good once we get there. The travel from optimism to pessimism, that tends to be a really rough road for stocks.
Right. Super helpful, Willie. Let's talk a little bit more about interest rates if we could. We've got the Fed coming up here in a couple weeks with the September meeting. The market's sort of pricing in, no change to rates, which seems to be right. But we continue to get economic data that I feel like every data point makes everyone sort of rethink the entire trajectory of the Fed. How important is it, do you think, here in the September and going through the subsequent meetings in 2023 about the Fed taking additional action? Do you think the expectations of the Fed, sort of being done hiking rates are priced in, or is that an additional sort of X factor we haven't priced in yet?
Yeah, so I think the expectations are that they don't do anything in September. There's about a 50% chance of one more rate hike in either November or December. The big uncertainty from my perspective isn't the additional tightening, but when do they pivot to easing? And I think that is further in the distance than most investors expect. And over the coming meetings, I think the Fed's going to have to send that message via their economic projections, via their dot plot, because their dot plot right now suggests 100 basis points of tightening next year. I don't think Powell and company want the market thinking that they're going to be cutting rates by 100 basis points next year. I don't think that's helpful to their fight against inflation. So I think that's the messaging. It's not additional rate hikes, but what the expectation is for the path of rates, or the level of rates, and how long they're going to stay high.
It's a great point, Willie. Just one last question here. One of the things we talked about was just how we've not really seen a rotation into defensive sectors. And that's one of those kind of warning signs that we look for, right? Is things like utilities, real estate, staples, kind of really bearish positioning of sorts. What sort of rotations are you seeing, and where do you see opportunities here as we're sort of seem to be in a holding pattern, choppy environment? What would you be looking at opportunistically here in the next month?
Yeah. So from an equity within equities, you mentioned energy is improving. I think that's an area to look at. It's underowned historically. I think the energy sector is something like 4% or something like that of the S&P 500, about half what Apple is. From a asset class perspective, I think looking at commodities, I think that they've been in a downtrend. But they're starting to gain a little traction. If I'm right about rates staying high for a while, I think commodities could do well. I think rates being high, it hinders that rotation into defensive areas. So I really think the rotation into commodities, perhaps away from bonds, perhaps away from equities, would be the thing to look at as we over the next couple months.
That's great points and well said, Willie. I think I heard you just say Apple's double the weight of the energy sector in the S&P, and I think that math checks out, and that's concerning. I feel like when you take a step back. This was a lot of fun, Willie. Thanks as always. Great charts, great perspective. Thanks for giving us some food for thought. Stay cool and stay well there in Milwaukee. We'll talk to you again soon.
Okay, thanks a lot, Dave. Thanks for having me on.
That's Willie Delwiche. Willie's investment strategist and founder of High Mount Research, coming to us from Milwaukee, Wisconsin. What a thoughtful strategist, some really interesting ideas. I love that sort of discussion. We think about the Fed and what the expectations are, particularly when and if and when, I won't say if, but I'll say when they start easing and rates start to come down. I think that's way down the road. I think Willie has a great point there. And it certainly feels like with the positioning you still see in a lot of growthy stuff, it feels like people are pricing in that that's a much closer finish line than I think it might be. That's something I'll be thinking about a lot further, and point well taken on the uptrend in rates. Great take there as always by Willie Delwiche of High Mount Research. We have to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes to tell the story of this market environment. Here is chart number 1. I mentioned earlier today, I was doing our monthly chart review with my Market Misbehavior Premium members. A lot of fun to go through some longer term charts and just think about big picture trends and themes. One of the things we were looking at was cap tier performance year to date in 2023. Now, if you really want to set up your sharp charts with lots of colors, you can do it. I have 10 different ETFs looking at basically the different caps and styles. So large cap growth all the way down to small cap value, everything in between, micro caps thrown in there as well. And I'm just looking at year to date returns in each of these buckets. The S&P 500 for now up about 17% for 2023. Large cap growth, which would be the mega cap technology, communications types of names and others, similar companies and stocks, up 22%. So outperforming the S&P by about 500 basis points or 5% so far year to date. Just switching from growth to value gets you still a good year, but only up less than 12%, about 11.7%. Mid caps on average yielding about 7% here year to date, and small cap core up about 4%. You can see small cap value the worst performer, micro caps even down for the year. So the story of 2023 to date has been about being in growth at the expense of anything else and being at the largest growth companies, and anything you've done outside of that has basically helped you or hurt your performance relative to those mega cap leadership names. If this is that corrective period that we've talked about, and if rates do go higher and or remain elevated, I would agree with today's guest, Willie Delwiche. I think that puts a lot of pressure on some of the best performers year to date. Talk about a rotation that people are under positioned for, and that is usually an area where I tend to find opportunities. Chart number 2 is Apple gapping lower today. I meant to get to this in our market recap, just got to too many other charts, but Apple gapping lower, trading higher today. We highlighted another name, I think it was Seagate, gapping lower and trading lower. This is a little different. We're gapping down to a potential support level and actually trading to higher today. today, but Apple's still down 3% for the day. That's not a good read on one of the biggest names, the biggest name, and certainly a large component to the XLK and the NASDAQ 100. We're still above Fibonacci support right around 169, 170. I think it holds this level, holds the August low. Things are not getting that bad. What happens when Apple goes sub 170? What happens if Apple breaks below the 200-day moving average? That, I think, would mark the next leg lower. And I'm looking at the momentum sort of in the bearish phase for sure. Finally, Boeing, shout out to a local Seattle-based company here, of course. You know, we've highlighted the chart of Boeing before, and I remember vividly highlighting on this gap day because it has this great sort of consolidation pattern for about 6 months, gaps higher and breaks above that resistance. Call that a big base breakout. I think what happens a lot of times looking at charts like this, things that should be good breakouts, but they don't follow through. I think that tells you a lot about the broader macro conditions, right? In a bullish phase, big base breakouts tend to work really well because it's a good sign of renewed optimism. It's a sign that prices are going higher for a good reason, and usually an influx of additional demand pushes prices higher and higher. That actually hasn't happened in the case of Boeing and other names as well. When breakouts don't persist, when breakouts happen but then fizzle down because people are thrilled to just take profits wherever they can, that tells me that we're more in a bearish phase than I probably want to admit. Folks, that's a wrap for this show. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Willie Delwiche from High Mount Research in Milwaukee. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.